Hello and welcome to this edition of Know Your 4C Fund Manager series. I have with me today Ravi Vukkadala. He's the CEO and CIO of Northern Arc Investments. Thanks a lot, Ravi, for joining me today.
Thanks for having me, Nitin.
Now, Northern Arc Investments has had a great track record over the last 6 to 7 years in managing a lot of fixed income AIFs, especially on the high yield side. And out of those various funds that you've managed, you've successfully invested in and exited out of 5 different funds, all at an IRR of net of expenses and pre-tax of in excess of 11 odd %.
That's right.
What is your investment strategy and which are the key sectors that you focus on?
Sure. So Northern Arc as a company is over a decade old, right? And it comprises of 2 entities in the group. So there is an NBFC and there is the fund business. Together we manage about 13,000 odd crores. And the company was set up with the mission of providing growth capital to enterprises to help them scale. Now that's been the ethos behind which we have always looked at sectors and looked at companies where we can lend so that they can grow. Now across these 13,000 crores and the same companies which are about 500 in number, we have managed to have an excellent track record. And that is because of a large focus on underwriting. So there are 2 levels at which you can do the underwriting. One is at the company level and one is at the fund level. Now across both, we have had a stellar track record. We are currently on our 10th fund, and 9 out of the 9 funds, 5 we have completely returned. So that's what differentiates us from the market, because some of the others have a promise for a return. Here we have already delivered. And while the focus has largely been towards financial services in the past, but over the last few years, we've done significant amount of investments in healthcare, education, logistics, platforms, and really broad-based the kind of companies where we lend.
Right. And a lot of people feel that you predominantly look only at the microfinance space. Are there any nuances within those sectors as well?
So microfinance is what we started with. So in 2009-10, microfinance was a sunrise sector. It was a sector where not everybody was lending. And it made sense, given our mission for enabling access to finance to the entire population of India, to focus on microfinance, because that's where you touch a large number of livelihoods at one go. Right? Now, a decade later, you have microfinance companies which are listed on the public markets. Banks have microfinance divisions. They have bought over microfinance companies. So it's not a early stage or a sunrise sector anymore. So while we did start with microfinance, today, microfinance is less than 30% of our overall portfolio. We have other forms of financial services, including fintech, and we have the other sectors that I just mentioned about, where some of those are not traditional sectors like steel, textiles, etc. These are newer sectors which are coming up, and hence their access to capital is more important. So that's where a large part of the focus is.
Right. Now, when you dig deep into these high yield spaces, right, there are 2 key risks that often investors kind of acknowledge, right? One is the credit risk, and the other is the illiquidity risk. So what kind of risk frameworks do you really have to manage these risks?
I think as soon as you start talking about investing, there's definitely a lot more about risk. I think risk is very misunderstood as well, because at least as soon as I hear the word risk, I am reminded of a very popular web series where the lead actor says, "Risk hai to ishq hai." Right? There, risk is thought of as something which is exhilarating, which is thrilling, saying that it is giving you some more action. Right? It's like driving a race car. But when you invest in fixed income and when you invest in credit, you want it to be as boring as possible. Right? So the way we look at risk is driving on a highway at 60 kilometers per hour, focusing on just getting to the destination, rather than having a wild ride which is giving you thrills towards the destination. Right? So the essential risk in that is credit risk, because risk of getting your money back is credit. Right? There are 2 other risks which come embedded as part of investing in fixed income. One is market risk, and the other, like you said, is liquidity risk. Right? Now, both of these risks will not give you additional return. Right? When you are investing money, you are getting the money or the income from taking credit risk. But market risk and liquid risk come as unwelcome companions, right? Somebody that you need to manage. So in that car example, getting to your destination and getting in that car is the credit risk. Market risk is the kind of volatility towards your progress towards the destination. Sometimes you're driving fast, sometimes you're driving slow. So depending on what is the external interest rate environment, your investment can be valued high or low. Right? But if you invest in a company at 80 rupees and the promise to pay is 100 after say 2 years, you will get that 100. Market risk is more about just the path from 80 to 100. Market risk becomes very, very front and center when coupled with liquidity risk. Because liquidity risk is essentially saying that no longer do I now want to hold my paper till maturity. I want to get out of that investment thesis. Right? Now, can you get out of that car? Right? And in some cases, you can get out very easily, such as in a government security or in a AAA name. Right. But in slightly lower rated companies or companies which are not very well known in the market, it is difficult to find a buyer. And hence the liquidity risk is high. We saw this play out in mutual funds, where when you combine liquidity risk and market risk, it can lead havoc with your original thesis of saying that I want to be paid for taking the risk of return of capital. So the risk framework that we employ largely has to primarily do with credit risk by assessing the company. But how you invest, like you invest in an open-ended fund, you invest in a closed-ended fund, what is the tenor, what is the secondary liquidity available, what are you offering in the product to the investor, that makes a real difference in terms of how you calibrate that risk in the portfolio. Right? So in a simple structure such as a equivalent to a fixed deposit or a fixed maturity plan, you are not taking any market and liquidity risk. You're taking only credit risk. And hence, in a closed-ended fund, we are only focusing on the credit element. In an open-ended fund, you need to have different frameworks which assess the liquidity on an ongoing basis, and you only promise the liquidity which is available via the portfolio and not blanket liquidity at any time. So it's a lot more in design,
right.
And the real essence is largely about underwriting with respect to credit.
Right. Now coming to this new term that has emerged over the last year or so, which is called private credit. And it's getting famous rather across the industry, especially in the high yield space. How would you like to explain to our investors in terms of what private credit actually means, not just from an investor's standpoint, but also from a taker of private credit, the company who's actually borrowing in terms of private credit, as well as a lender to private credit, someone like yourself, and the final client who's investing into funds which are private credit oriented funds, and how does this differ from venture debt in many ways?
So private credit, if you take down just the term, private means that it's not available for all. Right? It's privately placed, and something which is private is largely because it is not publicly listed or publicly available. If you invest in shares, it is called private equity. If you invest in bonds of a company, which is privately placed, it is called private credit. In essence, that is what the nomenclature says. So the lending or the investing has always been there. The labeling is new. Like you said, that this is a new term. The labeling has come over a year in the past because a bank which was lending to corporates or an NBFC which was lending to corporates, all of this was private credit. The capital has now become segmented. A bank is doing largely retail credit now. NBFCs are also doing retail credit. The equity markets are giving better valuations to retail and less diversified kinds of non-bank companies and banks. And hence, a large part of the wholesale credit has moved to structures such as alternate investment funds. Right? Mutual funds also do a part of it, but given the products that they run, it is lesser. So all the private placements are called off as private credits. Right? It can range anywhere from 9% to all the way up to over 20%, depending on what kind of structure it is. There you will see two broad segmentations. One is towards operating companies. So a company which needs it to grow their business. Maybe it is as working capital or it may be towards growth capital. The second will be towards a special situation that might come. Right? Somebody wants to do an acquisition, or there is a buyout, or there is a short tenor borrowing for a reorganization of a company. So such situations also come in the market. Financing for this is not available as per the regular channels of a bank or a non-bank. And hence, private credit funds aim to capture on these opportunities and leverage that and drive that return, because the risk is a little unique, and you need a specialty lens to assess that kind of risk. So broadly, that is what private credit is, right? Now to your second question, as to how is a company looking at private credit versus how a lender is looking at it or an investor is looking at it. So a company has multiple needs for capital, right? Suppose you still want to start a company, or you want to start, say, a restaurant business. Not that we lend to restaurants, but
Sure.
for example, somebody wants to start a restaurant business. If you go and ask for money, nobody's going to give you money. The first money comes from the proprietor or the entrepreneur who wants to start the business. That is the Series A, seed, angel kind of capital that they put in. They will identify a place, they will buy the machines, they will set up the entire place, they will buy the billing software, GST registration, interior decoration, all of that. And they'll identify the catchment area. Now, once the business starts showing some traction, once people start coming, eating, you start having some revenue receipts, is when other providers of equity will come in to provide some bit of scale. And once you can show that on a monthly basis, this is the amount of revenue that I'm getting, and you can show some sort of consistency on a business that is well known in the market, such as a restaurant business, then the debt lenders will come in. Right? And within debt lenders, depending on how risky is the credit or how big is the enterprise, it can be either private credit or public credit. A large company will obviously have a public issue. A smaller company, we look at it as a private credit. And within private credit also, so example is that suppose you need working capital for managing the day-to-day business of the restaurant. That is a simple working capital transaction. Now, if you want to add increased space because the business is doing well, you want to take the adjacent property or take the adjacent space and add more tables, for which you will get a 3-year or 5-year term loan or a term lending investment. Right? That's still an operating company, that is a private credit transaction. Suppose you want to use that same brand and start in a different city. Right? So that is more of an equity need, because there the business is unknown. It's a different catchment area. But venture debt kind of transaction, which takes heart from the fact that you know your business, you have proven it in a certain geography, and you want to replicate the same thing in a slightly more different geography, and you have the ability to raise money because of the demonstrated track record, we'll look at it from a venture debt transaction. So it's not a very clean differentiation with this example, but typically that's how the stages of capital work, and private credit usually follows post the venture debt stage.
Right, and you've been working on this space for some time now.
Yeah.
In some of your lead cases, can you just give us how it has been structured?
So it is quite unique in the sense every company, every transaction is quite unique on how you look at it. You may have simple transactions where assessment may be similar to how an equity fund manager looks at it from a macro perspective. Right? You look at macro, you look at GDP, you look at which is the sector, what is the cyclicality of that sector, what is the growth rate, what is the expected top line, and based on that, how is the market organized, how many players are there, what is the competitive intensity, and what is that company's position in that company. Right? So that is just a top down, you haven't even gone to the company yet.
Right.
At that level, you decide that I can invest in this kind of company. So your selection is largely on that particular company. Now, there are 3 aspects you look at. Who is borrowing? Why are they borrowing? And how will they give the money back?
Exactly.
Right? So who is borrowing, we have come to, right? From macro, from sector, to decide that what the company is about. Why are they borrowing? Is it towards adding a new facility? Is it about repaying somebody else? Is it for something like marketing expenses? Is it towards setting a new plant, factory, etc.? Each of those have different risks. In an operating company, it might be easier to have a standard business where a company has already borrowed in the past, wants to add one more machine, it's a simple transaction. Right? So there, the risk assessment as well as the structuring is simple, because all you're doing is lending to the company and taking that asset as collateral. If it is for a unique proposition, saying that you want to do a hostile takeover of a smaller business, there the structure becomes more complex, right? Because you're ring fencing the assets, you want to have the reason, what if something doesn't go right?
Yeah.
What is your claim on the existing assets? Which are the other lenders? What is the kind of moratorium you can give where you will not get back any cash flow? So that is how you may structure it. And then there are companies which are in newer sectors or vintages where you may not have that much of a history to compare. So for example, we recently did a transaction to a $40 million transaction was in the papers in the last couple of days to a warehousing and distribution as a service company called Rippler.
Right.
It's a newer company, but it is in an established logistics kind of sector.
Right.
So you will do the transaction and take some of the assets. You will also use some of the cash collateral. You will also have a structured credit line where the money has to be repaid at a certain frequency and then paid out again. So these are the 3-4 ways on which you can structure a particular transaction. Primary modes of repayment are cash flows, collateral, and balancing the risk is based on what is the tenor of the transaction.
Right.
You give a long tenor money, then the risk is obviously higher. You give a shorter tenor, it's definitely easier.
Got it. Coming to risks, which is the most critical aspect, how is it that you manage risks? Because underwriting is extremely crucial in such activities, right? So how is it that you actually manage risks when you enter into private credit strategies?
So the easy answer is that underwriting is only about effort. Right? If you put enough effort to know information, you will not go wrong. Right? And that is at the time of ascertaining a risk. Or suppose you come to me asking for a loan, which you never will, but as an example, right? I know you for a long time.
Right.
So I will have a financial assessment and non-financial assessment. Financial assessment is that you are employed here, you are earning a healthy income, and the other aspect is your assets.
Yeah.
What is the wealth that you have already had? So that is your additional collateral. So financial assessment on any company and underwriting is both an income level and an asset level.
Right.
And on non-financial, really depends on the governance, character, who are the kind of folks who are spearheading that company, what is the kind of track record, experience, etc. Underwriting is just about spending that kind of time to get all of that information. So put enough resources, ask enough questions, take your time, and then structure the transaction so that your interests are protected. That is at the time when you're giving the loan or the investment. Right? And you're a standard case where it's very easy to give credit. Assume that there's somebody who has joined your company recently as their first job.
Right.
There, the risk is much higher. Right? Either you might not know the vintage of the person or know their family background, and the predictability of income is also lower.
Right.
So there, you will have to look at other aspects as well. And while collateral is one, if you don't have collateral, the other way to contain risk is by the vehicle or the structure or the tenor.
Mm-hmm.
I will be happy giving you a 5-year loan. I might not be happy giving a 1-year loan to that new person.
Right.
So there are 2 levels at which risk is controlled, which is testament to our performance. One is you take a lot of time during underwriting, so on a particular exposure.
Right.
And the second is you balance the risk at the vehicle level. So when I say vehicle level, I am pooling capital together and I am giving money as a fund. When you are, or any investor is investing in the fund, you have an equal charge across all of the portfolio.
Right.
So for example, if my portfolio is worth 100 rupees,
Right.
and I have 20 investments of 5 rupees each at 10%. So every year I'm going to get 10%. So 100 will become 110 by the end of the first year.
Right.
Now for that particular example like I gave, if that person worth 5 rupees in the portfolio defaults and I don't get anything back,
Right.
then I have lost 5 rupees in that. So instead of 110, it becomes 105. But assume that you had only one investment in the portfolio, then that 100 becomes 0. So diversification in fixed income works the reverse of what it's supposed to do in equity.
In equities. Yeah.
In equity, it will help to depress your return. So your winners, which are supposed to be stratospheric, it will pull down at a portfolio level if you don't give enough weightage to it.
True.
In debt, if you give too much weightage to a company and it goes bust, then the entire thesis of capital preservation goes for a toss.
Right.
The other way is to decide the tenor of the exposure. Now, to that person, if I'm giving a 1-year loan and I'm saying you have to repay me monthly, then I know that within 6 months, half my money is already back.
True.
Right? So that 5 rupees exposure becomes 2.5. So it is a mix of both doing very strong underwriting at a company level, which is never foolproof. It is a good way of making sure that all your boxes are checked. But at the portfolio level, on how you design the product and how you structure the diversification, is when the capital preservation at a portfolio level matters. And combining these two with effective structuring for tax, tenor, etc., is what has been key to our performance.
Great, fabulous. So thanks a lot, Ravi. It was great having you on the show. It was very insightful.
Thanks a lot, Nitin. Happy to be here.
Thanks.
Thank you.